Welcome to the deep dive. We're here to take that stack of reading you send us, all the articles, the complex research, the data, and boil it down into something that really sticks with you.
And today we're getting into a really big one, a huge disparity that just won't go away in our economy.
The massive gender gap in finance, both in, engagement and in actual wealth.
Right. And you always hear that one sort of simplistic question. It's something like, why do men seem to care more about investing in finance than women?
But that whole premise, as your sources just immediately show us, is completely flawed.
It's just the wrong question to be asking.
Exactly. We have to just smash that idea right from the start. The gap we're seeing, it's not about who cares more or some innate ability, it's systemic.
Woven through history, through how we're socialized, through, well, straight-up economic factors.
So our mission today is to get way beyond that simple question. We want to give you an evidence-based look at what's really going on.
And we want to show you the surprising paradox that's really at the heart of all this.
Okay, so let's unpack it. We're going to take a journey from, centuries-old legal barriers that built the world we live in now, all the way to the psychology of confidence versus actual skill.
And then we land on the big reveal. The surprising truth about which gender is actually the more disciplined and therefore the more effective long-term investor.
So if you're looking for a few aha moments, you're definitely in the right place. But before we jump in, just a quick word. We really want to thank you for sending these sources over and trusting us with them. Our goal, as always, is purely educational.
And we do have to give the required disclaimer. All of our analysis is based on publicly available sources. The content is just for educational purposes. It is not investment advice.
So please do your own due diligence before making any decisions.
That's right.
And on that note, if you do want to track the total market temperature, you can search for and download our iOS app Buffett Indicator right from the Apple App Store.
And for more advanced content, you should check out our Deep Value Club membership.
Okay, let's start at the beginning. Because you really can't understand today's financial behaviors without seeing how recently women were just legally shut out of the economy.
Yeah, the foundations of this gap are much more recent than I think most people realize.
So when we look back, what did that legal landscape actually look like?
Well, for centuries, the main legal principle was something called coverture.
Coverture. Okay, that sounds pretty old school. What did that mean in, practical terms for a woman?
It meant that when a woman got married, her legal and economic identity was basically just absorbed by her husband.
So she just vanished, legally speaking.
Pretty much. She couldn't own property on her own, couldn't sign contracts, couldn't even control the money she earned. This was the law. It wasn't just the social norm.
And it wasn't until around 1900 that all states finally passed laws allowing married women to own property in their own name. 1900.
Exactly. And even then, just owning property wasn't enough. You still had to be able to use the financial system.
Right. Which brings us to something that is well within living memory for a lot of people.
Accessing credit. Think about something as basic as getting a bank loan or a credit card. A woman couldn't do that on her own without her husband's permission until the Equal Credit Opportunity Act of 1974.
1974? That's staggering to think about. For almost all of American history, women were legally blocked from being independent financial actors.
And that deep, long-standing exclusion created a kind of division of labor in the home that you still see today.
Even in dual-income households, right? The habits just stick.
It's the long shadow of it all. The sources you sent show men typically take the lead on the quote-unquote major decisions.
So the investments, pensions, insurance, the long-term stuff.
Yeah, while women are often left to manage the routine things like the day-to-day budget, paying the bills, that kind of thing.
And that might seem, efficient on the surface, but when you look at what happens during big life changes, you see how incredibly dangerous that setup is for women.
It's a setup for acute financial vulnerability. The data is so clear on this. 90% of women will be solely responsible for their finances at some point.
Usually after a divorce or when they're widowed.
Exactly. And they're often totally unprepared. Over 70% of divorced women and widows report these awful financial surprises.
Things like hidden debts or finding out the investment accounts are way smaller than they thought.
Yeah, and that 70% number is startling, but the actual financial hit is just brutal. We're talking about married women's finances declining by a staggering 41% after a divorce.
41%.
That is more than double the 21% decline that men experience. And, that's not just a number. That's losing your home. That's not being able to afford health care.
It's a total loss of security. So the problem isn't that women don't care. It's that the system basically encourages them not to engage until a crisis hits.
And by then, they're scrambling to learn from a place of huge disadvantage. Which brings us to how this whole thing gets reinforced today, not just through history, but through education and socialization.
Okay, let's shift gears to that, because it seems like financial education starts out gendered, right from childhood.
It really does. Survey after survey shows that boys are just way more likely to get financial advice from their parents, and they get it earlier.
A 2021 survey found something like 10.2 million more adult women than men missed out on those basic financial lessons at home.
And the data points to one main source for that gap: fathers. They are 3 times more likely to talk to their sons about it than their daughters.
So we're basically passing down the same old expectation. Men handle the serious money, women handle the spending.
Which leads us straight into what the research calls the confidence chasm.
Right, this is where it gets really interesting. On financial literacy tests, women consistently score lower than men. But that's not the whole story, is it?
Not at all. When you dig into how they answer, the picture completely changes. The lower scores are almost entirely a confidence problem, not a knowledge problem.
Because women are way more likely to pick the I don't know option.
Vastly more likely.
Yeah.
On one question about diversification, 63% of women chose I don't know. That created this huge 20-point gap with men, which, at first glance looks like a massive knowledge deficit.
But then the Federal Reserve did this fantastic experiment. They just took away that I don't know option and forced everyone to guess. What happened then?
The gap disappeared. That massive 20-point gap in correct answers just, it vanished. It shrank to a 1 percentage point difference, which is statistically nothing.
Wow. So the knowledge was there all along. It was just hidden behind a reluctance to guess, to be wrong.
You could almost call it epistemic humility. It's a low-risk, learned response. For women who've been told this isn't their area, opting out feels safer than being wrong.
Which is the total opposite of the male socialist tendency to just take a swing, take a guess. Overconfident.
Exactly. And that difference, prudence versus overconfidence, is what leads us to the biggest aha moment of this whole deep dive.
The performance paradox.
The performance paradox. Despite lower confidence, despite lower participation, women are statistically better long-term investors.
Okay. The data here is just so compelling. Give us some of the numbers.
A huge fidelity study, looking at millions of accounts, found women outperformed men by 0.4% annually.
Now, 0.4% might not sound like a lot.
But over 30 years of investing, it's a massive amount of money. The power of compounding makes that small edge turn into potentially hundreds of thousands of dollars.
And there was another study from Warwick Business School that was even more dramatic.
It was. It showed women outperformed the FTSE 100 index by 1.94%, while men only beat it by 0.14%.
That's a colossal difference. So what are they doing? What's the secret?
It's all about behavior. The outperformance comes from avoiding the cost of overtrading. There was a famous study called Boys Will Be Boys.
Right, I remember that one.
And it showed that men trade 45% more often than women, and single men, the most confident of all, trade 67% more.
And all that hyperactivity just kills your returns. Transaction costs, bad timing, interrupting the magic of compounding.
That's the whole thing. The study quantified it. Men's overconfidence and hyperactivity cost them 2.65% in net returns every year. For women, it was only 1.72%.
So women's patience there, lower turnover.
Mm-hmm.
It's perfectly aligned with classic value investing. Just sit still and avoid what Buffett calls unforced errors.
Exactly. Prudence just beats bravado.
But is there anything deeper going on here, maybe? Biologically?
Well, there's a growing field of neuroeconomics that suggests there is. Research has linked higher levels of testosterone to, over-optimism and a bigger appetite for high-risk, immediate rewards.
So the impulse to chase a hot stock or jump into a market bubble might actually have a hormonal component.
It seems so. In experiments where traders were given testosterone, they generated much bigger and more pronounced price bubbles. It aligns perfectly with men's tendency to chase momentum, regardless of an asset's real value.
And you see this playing out right now in the most speculative parts of the market.
Oh, absolutely. Look at crypto. Men make up 61% of global crypto owners. And during the whole meme stock frenzy, a staggering 86% of those trades were made by men.
By staying away from assets with no intrinsic value, women are implicitly following the rules of smart, long-term investing.
It's a powerful conclusion. If you want better long-term results, you should be copying the behaviors of the average female investor.
Okay, but that raises a huge question. If women are better investors, why is the overall wealth gap still so enormous?
We have to go back to the structural roadblocks, because no amount of investing skill can make up for a fundamental lack of capital.
It all starts with the pay gap.
The foundational barrier. Women working full-time still only make about 83 to 85 cents for every dollar a man earns, and that number has barely moved since 2002.
That is such a critical point. It's not a care deficit, it's a capital deficit. It's hard to get excited about investing when you have systematically less money left over at the end of the month.
And that lower income stream directly creates a massive gap in accumulated wealth. The wealth gap is just staggering. For every dollar of wealth a man owns in the U.S., a woman owns just 32 cents.
32 cents. That's the accumulated cost of decades of lower pay, career interruptions for caregiving.
And it all comes to a head in retirement, which for many older women is a full-blown crisis.
What do those numbers look like?
Women have 30 to 32% less income in retirement, and they have to make a much smaller nest egg. A median of $50,000 versus $157,000 for men lasts for a longer lifespan.
It's a recipe for poverty and old age. Just an incredible amount of pressure.
It is. But the sources you sent also point to a huge demographic shift on the horizon that could force the entire industry to change.
You're talking about the great wealth transfer.
The great wealth transfer. An estimated $30 trillion in financial assets is projected to shift into the hands of American women by about 2030 to 2045.
Mostly through inheritance.
Yes. And this isn't just a trend, it's a seismic event. It will force wealth managers, brokerage firms, everyone to finally change their culture and their products to serve what will become their dominant client base.
So given that this problem is so deeply rooted, what are the big recommendations for change?
Well, on a policy level, you have to fix the capital deficit first. That means serious legislation to close the pay gap, like the Paycheck Fairness Act. And it means supporting caregivers.
Paid family leave, affordable childcare.
Things that prevent those career interruptions that are the primary driver of lower lifetime earnings for women.
And what's the takeaway for individuals if you're a woman listening to this and feeling that confidence gap?
The message from the data is clear. Just get in the game, commit to participating. You don't have to be a confident guesser. You just have to be an informed participant and build that knowledge on top of the discipline you already have.
And for men, the takeaway is to be an ally, to really challenge these biases and make sure financial responsibilities, both the bills and the long-term strategy, are truly shared.
Absolutely.
So we started with this idea of why men seem to care more, and we've ended up with this powerful evidence-based conclusion that the gap has nothing to do with caring or ability. It's about systemic barriers.
And in fact, the data shows the empirically superior strategy, patience, prudence, low turnover, is the one that's traditionally associated with women.
Which leaves us with a really important thought to reflect on.
Yes. The future of successful finance really seems to depend on adopting this female model of investing, which values endurance over excitement. So the question for you to think about is this. How might the entire financial world look different if patience and discipline, the very traits that generate superior returns, were celebrated as the ultimate signs of financial sophistication instead of aggressive, hyperactive trading?
That is a challenging and an incredibly hopeful thought to end on. We hope this deep dive has given you a much clearer view of this critical topic.
And remember the disclaimer. All this analysis is based on publicly available sources and is for educational purposes only. It is not investment advice. Please conduct your own due diligence before making any investment decisions.
And if you do want to listen to our full deep dive on this or access more advanced content, you can join our Deep Value Club membership.
Or you can subscribe to us on Apple and Spotify podcasts. The channel is Deep Value Investing.